It's an absolutely valid point, and it's one that we battle with all the time. Now, the way we've dealt with it within SIX Group, which I actually think is, and this isn't self-serving, just objectively, it's not a bad way to go. We've taken every business line within the group and categorized it along 3 lines, whether it's a monopoly position that's infrastructure relevant, a competitive business but infrastructure relevant, or purely competitive. So for instance, the first category, monopoly infrastructure relevant, would be Swiss Interbank Clearing, the cash clearing side, and SIS for the domestic business. The second category, which is infrastructure relevant but has to compete, the stock exchange and the CCP are clearly in that category. And the third group are things like telecourse and the cards businesses and so on that we run. Each one of those categories has a different approach in terms of how we do pricing. The first category is run on a not-for-profit basis. So effectively what I do at the end of every year, I look at what we need to invest for the future, how has the domestic business done, and we give a rebate back to the market if we don't need the funds for either the capital base or for future investments or whatever. And of course that's not done on the third level where we're purely competing. And the idea is essentially to say we run the businesses commercially, but there are areas where we have a responsibility to the market, and at that market, I mean, our shareholders are our customers, but they're still looking for a dividend, and they're still looking for relatively tough targets in terms of business growth and so on. So I have to offset declining transaction volumes, for instance, in my domestic market because of increased netting, with getting more business outside of Switzerland so I can keep my unit costs down, because the fixed cost engine is there. That model works pretty well, but it requires a fair amount of trust, and it means you've got to be prepared to accept a lower overall profitability. But essentially what our customers have told us is we'd rather have a fee reduction than a dividend, if for no other reason than tax reasons.
Yeah, I think it's a great question. Again, kind of as an outsider looking in here, maybe is it a two-edged sword? If it's, if we're talking about the code of conduct, but we're also talking about protecting, shareholder revenue, does that in turn protect the silo? I don't know the answer to that. Is that a relevant point? Because one of the things, if we talked about interoperability being desirable, does that demutualization reinforce the shareholder revenue and protect the silo?
If we close ourselves off, at some point that market will be dead because the liquidity will move abroad. There's no question about it. But cross-subsidization itself isn't the issue. It's about being transparent with what you're doing. Sorry, Tom.
I was really going to challenge Ruben, who seems to be saying that competition is absolutely great. We want organisations to fail, but because that will give better price discovery. And the problem I see is that we haven't got, particularly at the central counterparty, that mutualisation of risk, so that if we are competing and we leave the risk aspect there, that we can all step away with the default fund, we've left ourselves with a pretty strange infrastructure. And your thoughts on that, because that is the dynamic that we currently have.
Delighted to answer that, but let me step back a little. Chris, do you want to respond to any of this?
Yes, I violently agreeing with Tom, because I think one of the questions I think was flagged that we'd be addressing was this whole question of silo versus horizontal. And I think at the end of the day, you've got to look at who's benefiting and what are the needs of those beneficiaries. One of the things that I think has suffered as a result of, shall we say, modern markets, if not demutualized, is the public. Because one of the key outputs of what it is we do are fair and representative prices for the stocks that people put in for their pensions, their investments, and so forth. And when you have your main market, your main exchange accounting for 50% or less of the prime stock index, where does the public go to get an idea of what is a fair and proper price for their investments and their future livelihood? And I think that's one area that has suffered as a result of the Reuben Lee organisational structure of modern capital markets.
And if so, what's the best way of governing these infrastructure monopolies? Okay. I'll start off at the either end. If you don't have any comments, that's great, because it's not really in this. Do you want to say anything? Nothing. Jitu, would you like to?
Yeah, no, I'll continue with what was said about Crest and comments from Ian Saville. And for those of us with grey hair who knew a bit about Taurus, that didn't quite work. And then obviously Crest came along. It was a big challenge, and everybody sort of questioned whether the Crest was going to work or not. And then Gilts market arrived, and everything worked. And if you look at it today, it works very, very well. Now, people may call it monopolistic because that's the way it is, and Euroclear run it. But I think they do an extremely good job in making sure that it runs every day, and there are minimal issues. So there are some infrastructures, I think, that require, whether you call it monopolistic or it's a community-led service where everybody agrees, a minority may disagree. And going back to the comment on T2S, I still have a view that T2S is good. I'm not saying whether it will not work or not work. I think it will all depend on the contribution of the constituents to make sure that it works. So for me, to answer your question, I think it's not monopolistic. That's the issue. I think it's the willingness of the participants to actually agree at a majority level that that's a good thing for the industry and the end client. I think that's more important now. There's always going to be debates whether it's good or not, but sometimes you've got to manage that risk and continue. Otherwise, we'll have fragmentation.
Let me phrase this in a particularly Swiss manner, which is that my understanding is basically your users are your owners.
Correct.
And what I'd like to ask of you is, do you think that allows you to provide the best infrastructure possible, both domestically and in a more international context? Or do you think that you're constrained, for example, through lack of capital or whatever it may be? Tell me about your governance structure.
You haven't looked at our balance sheet, have you? It is a user-owned, user-governed structure. I think we have advantages in the sense that we can take longer-term decisions that require significant investment over many years without having to worry about a quarterly stock price and so on and so forth. Apart from that, I don't think it makes a great deal of difference. If you agree to run your businesses in a different way and accept that you will therefore get a lower return for some of those businesses, and your shareholders are okay with that, and I mean, if you're transparent about what you're doing, then your shareholders would know that when they're buying into the security, then that doesn't necessarily become the killer criterion that says user-owned, user-governed is better than a demutualized structure. I mean, each model has its pros and cons. There are certainly some limitations that we face in terms of our expansion plans that have nothing to do with capital, but have to do with, when we work with other firms abroad, they would like to have a stake, and that's not the easiest thing to construct. We have a very long-term shareholder agreement that's fairly rigid, which gives us great stability, but doesn't let you enter into joint ventures all that easily. So there are restrictions, but I'd argue certainly from a financial security point of view, we're in much better shape than companies that have had to pay out significant dividends.
I'd need about a quarter of an hour to untangle that question.
Nothing I say is right.
You started. I think, again, just trying to sort of pick up the flow of discussion. What's the best way of handling that? I'm about to say that in my sort of career, I worked for two infrastructure organisations that were both mutuals. They were both, if you will, clubs, trade associations, cooperatives, call them what you will. And I'm bound to say they were the easiest organisations in which to innovate, because I think it's possibly still the cooperative is the best way of getting consensus in this industry of cats that you're going to get. Because it's only with consensus that you can go forward and have a discussion about what consensus would support in terms of innovation. But above all, having got the innovation supported, you've then got the consensus of the membership, the participants behind you. And I think probably in the sort of the rush to embrace the future, that's one of the things that certainly CCPs and CSDs do forget. There's this need to bring your community of participants with you.
Asking you to marry two things, to marry the optimistic with the pragmatic, okay? So I'd like you to tell me, within a reasonable time frame, let's say a 3-year horizon, what would be the best that we could hope for, optimistically but pragmatically, in terms of industry structure in clearing and settlement? And you can take that where you will. So you can talk it cross-border, you can talk it vertical, you can talk it governance.
Okay.
Your optimal, realistic solution over 3 years.
Okay, I'll comment with my experience with my broker-dealer hat on. On the very optimistic view, I've been quite privileged to work with 3 CCPs in the OTC market, and it's delightful to see the amount of knowledge and share of knowledge there is in the broker-dealer community, who I optimistically believe will find a route to the solution itself. I think they have a very good pragmatic idea whether CCPs will survive, not survive, netting, whether it's central or bilateral, governance issues, because they have to make sure that they continue to serve the clients. So the optimistic view for me is I think the users will take us to the direction and also force hands for CSDs and other players who provide them services.
I think the best that we will be able to hope for to have a reasonable degree of efficiency and control this compromise is that we'll probably end up with 3, maximum 4 main groups that will look at pan-European post-trade. The rest will go to the wall, be absorbed, or outsource. And I think, unfortunately, it will not be coupled with a significant reduction in cost. I think the cost will shift quite dramatically to reporting costs and compliance costs, and we'll see that there will be a much greater centralization of data to be used by various entities in Europe. And there's going to be a cost associated with providing all of that, interpreting it, reporting it back, and someone's got to pay for it.
I'd actually written down the figure 4 groups operating within the EU market on post-trade. Inevitably, I think that implies a degree of integration between clearing and settlement, which may not happen at the moment. And I do think that they would involve a much broader range of assets than just securities going through clearing and settlement.
I think the optimistic view would certainly be interoperability. I think the establishment of best practices between participants is something that's going to happen. The pragmatic view is it's not going to happen willingly, and it may not happen in the short term.
Ladies and gentlemen, for the panelists, thank you very, very much.